The $100 bill in your pocket today will buy about $40 worth of stuff in 25 years. You won't lose a cent of it. It'll just quietly shrink. That's inflation, and it's the most powerful force working against your savings that almost nobody plans for. Prices don't ask permission. They rise a little every year, and your money buys a little less. Let's see exactly how much it costs you and how to beat it. Inflation just means prices rise over time. A few percent a year sounds harmless. But at 3%, prices double in about 24 years. The same groceries, the same rent, twice the price. And it isn't always the number on the tag. Sometimes the price stays the same while the box quietly gets smaller. Same dollar, less cereal. It's called shrinkflation, and it's just inflation wearing a disguise. So watch what happens to money that just sits there. $10,000 kept as cash. In 10 years, it buys about $7,400 worth. In 25, under $5,000. You never spent it. It simply lost half its power. To really feel it, look back. A movie ticket, a gallon of gas, a loaf of bread, all cost a fraction of today's price a few decades ago. Your grandparents weren't richer. Their dollars simply bought more because the inflation hadn't happened yet. Stretch it across a working life, and the numbers get staggering. A dollar from the mid-1970s buys you well under 20 cents worth of stuff today. Prices didn't go crazy. Time and inflation just quietly did their work, decade after decade. This is the part that catches people. We're taught that cash is the safe option. But cash guarantees a loss. Every year it sits in a zero-interest account, it quietly buys less. Safe from crashing, yes. Safe from shrinking, no. Worse, inflation compounds, just like interest. Each year's rise builds on the last. So 3% doesn't mean prices are 30% higher after 10 years. Because it compounds, it's closer to 34, and it keeps accelerating from there. Economists sometimes call inflation a hidden tax, and it's a fair name. Nobody sends you a bill. But every year, a slice of your money's value quietly disappears. You feel it at the checkout, never on a tax form. Here's how it hits your income. Say you get a 2% raise, and inflation is 3%. It feels like more money, but you can afford less than the year before. To truly get ahead, your pay has to beat inflation, not just match it. And the official rate is only an average. Your personal inflation depends on what you actually buy. If rent, healthcare, or tuition dominate your budget, and those climb faster, your real inflation can run well above the headline figure. Which is exactly why simply saving isn't enough. Here's $10,000 in cash, slowly losing value to inflation. And here's the same $10,000 invested in a broad index fund. One quietly melts. The other outgrows inflation and keeps its buying power, and then some. So investing isn't really about getting rich quick. For most people, it's simply the only reliable way to stop inflation from eroding a lifetime of savings. You invest to protect what you have first, and to grow it second. That's the whole game. To protect your money, it has to grow faster than prices rise. Historically, owning assets, stocks, index funds, sometimes property, has done exactly that over the long run. Cash never has. People often reach for gold or lately crypto as an inflation hedge. The honest answer is mixed. Over very long periods, gold has roughly kept pace. Crypto is far too new and wild to count on. Broad, productive assets like index funds simply have the steadier track record. The reason productive assets win is simple. A company can raise its own prices when its costs rise, so its earnings and its stock tend to climb right along with inflation. Gold just sits in a vault. A business actively fights inflation on your behalf. Now, the honest nuance. A little inflation isn't a glitch, it's the target. Most central banks aim for around 2% on purpose, because gentle inflation keeps an economy moving. The goal was never zero. Here's why they don't aim for zero. If prices fall, deflation, people stop spending, waiting for things to get cheaper. Businesses cut jobs, the whole economy stalls. A little inflation keeps it moving. Deflation is the scarier problem. Inflation isn't equal for everyone. It quietly punishes savers holding cash. It can actually help people with fixed-rate debt, who repay with money that's worth less. And it rewards those who own assets that rise along with prices. That middle one surprises people. If you have a fixed-rate mortgage, inflation is quietly on your side. Your payment stays the same while wages and prices rise around it. Over decades, inflation makes that fixed debt easier and easier to carry. But inflation is cruelest to people on fixed incomes, like retirees living on a set pension. Their costs rise every year, while their income doesn't. It's a big reason even retirees are usually told to keep some money invested, not all of it in cash. And watch ordinary savings accounts and bonds. If they pay 2% while inflation runs 3%, you're still slowly losing ground. The balance goes up, so it feels like winning. But in real terms, after inflation, you're quietly going backwards. To see how relentless it is, use the rule of 72. Divide 72 by the inflation rate to find how fast prices double. At 3%, that's every 24 years. At 6%, every 12. Your grandparents' prices were in a different world, just earlier on the same curve. For the safe portion of your money, some tools are built for this. Certain government bonds, like inflation-protected treasuries, adjust their value up with inflation. They won't make you rich, but they stop your safe money from silently melting. So what do you actually do? Keep enough cash for emergencies and short-term needs, where safety matters more than growth, but money you won't touch for years shouldn't sit in cash. It belongs in things that grow, so inflation works with you instead of against you. And make it automatic. Set money to move into your investments every month, before you ever see it. That way, out-earning inflation stops, depending on willpower or memory, and simply happens quietly in the background, year after year. There's a mental trap here called the money illusion. We instinctively think in the numbers on the bills, not in what they buy. A bigger number feels like more, even when it buys less. Learning to think in real after-inflation terms quietly improves every money decision you make. So the plan. Keep a few months of expenses in cash for safety and no more. Put long-term money into broad, low-cost index funds that historically outpace inflation. Push for raises that beat it. And where it makes sense, use fixed-rate loans, since inflation slowly erodes them for you. One last warning. When markets get scary, the instinct is to flee to cash for safety. But over decades, that supposedly safe cash is exactly where inflation does its quiet damage. The bigger long-term risk usually isn't a market dip. It's holding too much cash for too long. Inflation quietly shrinks money that stands still and quietly rewards money that grows. Keep what you need safe, put the rest to work, and time turns from your enemy into your ally. For one money idea, honestly visualized, every week, subscribe to Money Visualized.